senior partner from Shah and Associates. He leads the firm and has over 35 years of experience and in providing assurance and corporate services to diverse range of industries. He is associated with our institute in several capacity as member of Ind AS Implementation Committee, Ind AS Technical Facilitation Group ITFG, co-opted member for Auditing and Assurance Standard Board, panel of technical reviewer formed by FRRB. He is also a co-opted member of the Expert Advisory Committee for 1819. He is member of Professional Development Committee of WIRC, apart from being committee member of BCA. He is currently on the executive board of not-for-profit organizations like National Burn Center, Somaya Education Trust, Rotary, etc. Sir is a voracious reader by nature and he has hobbies of gardening. With this brief introduction, I would like to call upon our past president, Mr. Vipul Joshi, to give a small memento to the speaker and to start this session. Thank you.
Thank you. Thank you. Thank you. Thank you, Arpita, for the kind introduction. Good evening, friends, and welcome to all. The Chamber of Tax Consultants has been a pivotal institution in providing professional services, if I may say so, through the various seminars and webinars which it has been conducting. I personally have been a big beneficiary of the programs conducted under the aegis of CITC. So this evening, what we have are tax audit reporting issues and MAC compliances or challenges with the company following Ind AS. And as we know that 18-19 has been the first year where NBFCs above 500 crores have transitioned to Ind AS. So there are a couple of points arising out of specific to NBFCs, maybe the magnitude of questions or the impact may be a little larger compared to the other industries who are following Ind AS. Since the transition to Ind AS has happened for over now 3 years, I have tried to restrict the questions more which are pertinent to the current issues, while there may be many other challenges built around the tax audits which have been dealt with in the past. But in order to keep this seminar or webinar little brief, there are limited points. And obviously, as the topic is talking about issues arising out of tax audit reporting, so I'm not really taking about computational challenges which are flowing outside the tax audit reporting or for that matter under the MAT reporting. And those probably will have to be taken up as a separate topic by itself. Briefly, the okay. So the broad coverage only for the Ind AS companies are broadly spoken up between tax audit issues, MAT issues, and some of the items relating to NBFC on account of their first-time adoption. So let's begin with the aspects relating to tax audit. And the structure of this presentation is that to your left, you can see the current reporting requirement. To the right, what you can see are the challenges while doing the reporting for Ind AS companies through the tax audit. And first question, which is coming up specifically, is under para 13B, which says that whether any adjustment is required to be made to the profit or loss for complying with the provisions of ICDS notified under 145(2). And in this, I'm talking about specifically in relation to inventories. As you know that currently for real estate developers, the ICDS is still at the draft stage, but the other ICDS provisions will still apply. And specifically for Ind AS, one of the big challenge is the treatment of borrowing costs in regard to the real estate development. As we know that the revenue recognition can happen over a time or it can happen at a point of time. Just to for the benefit of the audience, over time is what we always knew as a percentage of completion, and the at a point of time is when the both the delivery and the receipt happen simultaneously. So which will in real estate parlance is what we call a completed commitment. Now the question is that you have borrowing cost, and the borrowing cost can be in relation to the units which are already ready, which obviously under the inventory for completed finished goods you obviously cannot capitalize. But the question is pertaining to the units which are under work in progress and which are unsold. Until 1st April 2018, while the erstwhile Ind AS 18, we had our specific guidance note on the real estate accounting where the borrowing cost could have been added to the unsold inventory because it took substantial period of time to complete. Now when we come to 1st April 2018 onwards with the Ind AS 15, where we do not have the benefit of the same guidance note, and therefore the question is that between Ind AS 115 and borrowing cost, which is your Ind AS 23, what will be the treatment of borrowing cost under the books, and what will be the treatment of borrowing cost under the tax audit, which is under your ICDS 2. For those who have read the IFRS committee advice in March 2019 when they gave out their final view, what came out was that under the IFRS committee's view, because the entity is following an over time revenue recognition method, and which means that at any point of time what is unsold is capable of being sold. And therefore the question which arose was that whether under IS 23 borrowing cost, whether could you have capitalized the borrowing cost to the unsold inventory. They analyzed the various aspects of what is substantial period of time, whether undoubtedly real estate projects certainly take a long duration of time to complete, and by normal understanding the borrowing cost should be added to the cost of the inventory. But the flip side under 115 is that because this inventory is always available for sale, the staff committee came to a conclusion that you cannot capitalize the borrowing cost when you are following the revenue recognition principles at over a period of time. Now this is in March 2019. There is divergence of accounting policies which we have seen, but be that may, now comes a question that for a company which applies the borrowing cost as a full business expenditure, full borrowing cost in its profit and loss account, the question is, does it bring a challenge under the paragraph 13D reporting? Now ICDS 2 valuation of inventory, as we know, that it says that any borrowing cost directly in relation to bringing an asset into existence has to be capitalized. So this will be the first impact the company will face, that in its profit and loss account it will expense out the borrowing cost and it will have to add it for the valuation under ICDS. Until last year also there was a similar challenge for the companies who had specific borrowings for the purposes of building the inventory. In the intervening period, it deployed those funds and earned interest. As we know that the borrowing cost has to be a net cost to the company, and therefore only the net cost was considered for the purposes of capitalization of the unsold inventory. And under the ICDS even for last year, the specifically the aspect of interest earned had to be offered for the purposes of tax, and the gross interest had to be added to the cost of inventory. And that obviously brought about another set of challenges, that when you are recalculating the interest cost, whether your POCM should also be restated or should not be restated. So these are the two fallouts out of the borrowing cost, particularly in relation to the real estate developers. And this may be true even for large companies who are following the over a period of time uh, revenue recognition policy. This can also be true for the capital goods. That brings me to the second challenge and confusion. And this is paragraph 16, which says amounts not credited to the profit loss account. And I'm specifically referring to para D, which is any other items of income. Now, what does this in context of employee welfare trust or an ESOP trust, which is treated as an extension of entity? As we know that these are special purpose vehicles, you can have a view taken by a company that whether will I treat this trust as an extension of entity, which means you are treating it like a branch, or you can say it's a controlled entity. You do nothing in your standalone, but you will, in your consolidated financial statements, you will consolidate this entity, subject to the treasury shares which you have to deal in your standalone. But you do not consolidate as a part of your standalone financial statements. But let's take a situation where in the standalone financial statements, the entity has treated such welfare trust as an extension. As we know that this trust can hold shares, it can hold some other assets, it can have its own source of income, it will have its own source of expense. And under the Ind AS accounting standards, any gain or loss on disposal of the shares of the entity by such trust cannot be credited to the profit loss account of the standalone financial statements, even though this is treated as an extension of entity and will have to be routed through other equity. And the question now which arises is that what you are crediting under the other equity as an income, obviously the transaction between the entity and the trust will get eliminated because you will not have the interest income and you will not have the interest expense. But if you had other source of income or the gains out of sale of shares to the external market, which is credited to the other equity, question is the entity required to report such income credited to the other equity and disclose it under paragraph 16D. There can be a view that the ESOP trust or the welfare trust is an independent entity, it is an irrevocable trust, and therefore it's a separate taxable entity, and therefore no adjustment is required to be made in the tax computation of the entity, and therefore no reporting under 16D. But at the same time, there can also be a view taken by the entity that ESOP trust, even though it is irrevocable, can be clubbed in my tax computation. And if that be the case, then in the tax audit under para 16D, the nature of income which is credited to the other equity will have to be reported under this paragraph. As we know that currently the legal views taken, or there is no format to add, and so therefore each of the tax auditor will have to take up a view that whether if it is not going to disclose under 16D, the legal position of the taxability of ESOP trust or the employee welfare trust is correctly established, and therefore there is no non-disclosure under paragraph 16D. That brings us to the third case study, and this is a question under paragraph clause 16, again applicable mainly for real estate and others as well. And the question here is that where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or assessable by any authority of the state government referred to in section 43CA or 50C. Please furnish details of property, consideration received or accrued and value adopted or assessed or assessable. And what is the information to be given is details of property, consideration received or accrued, value adopted or assessed. And essentially value adopted or assessed mainly by the stamp duty authorities. So the question in this paragraph is, when do you do the reporting? Do you do the reporting in the year when you have a binding arrangement, which means that you have given a letter of allotment which is virtually equal to a legally enforceable agreement? So while I may not have executed an agreement for sale or I may not have executed a sale deed, but that letter of allotment per se has all the characteristics of a binding arrangement. So is that reporting under para 16 to be done in that year? Do you do it in the year of registration? So take an example, year 1 I have a binding arrangement. In year 2 I have a sale deed and I register it. Or I have year 3 from where I start recognizing the revenue either under the over a time or at a point of time. Now we can have one transaction, but we can have in 3 different years. Logically, for 43CA, the reporting should happen in the year in which there is a binding arrangement and not at a subsequent point of time. There have been a lot of deliberations and disputes around the applicability of 43CA, but because of the specific provision which says that your stamp duty value should be with reference to the year in which there is a binding arrangement and not with reference to the stamp duty value in the year of registration. Because as we all know, that even in the state of Maharashtra, every year the stamp duty authorities are altering the value for every circle, and therefore your stamp duty value in year 1 is not necessarily the value in year 2, and therefore you can have a different stamp duty valuation when you register it. So that should be your paragraph for paragraph 16. The reporting, in my opinion, should happen in the year in which there is a binding arrangement. There is obviously a question that when should this income be offered, whether should it be offered in the year in which I've reported, or should it be added in the respective years in which I do the underlying income offering. This is a subject matter of discussion and dispute with the tax authorities, while they would like to add the income in year 1 irrespective of whether the revenue from the transaction is being offered in the subsequent years or not. But yes, this is one certainly an area of debate and deliberation which is happening in the real estate fraternity. So para 16, in my opinion, will be the earlier of the transaction of binding arrangement and not in the subsequent years when the income is recognized. So that brings us to the fourth challenge or confusion. And this is with reference to para 29A, which says that whether any amount is to be included as income chargeable under the head income from other sources as referred to in clause 9 of subsection 2 of 56. Now, as we know that section 56(2) deals with 56(2)(9) specifically deals with the aspect of, and I will read for the benefit of the participants the para 9, which says any sum of money received as an advance or otherwise in the course of negotiation for transfer of a capital asset, if A, such sum is forfeited, and B, the negotiations do not result in transfer of such capital asset. So typically, as we know that there was always an argument that when I receive an advance and the underlying transaction does not get fructified in relation to a capital asset, there was always deliberation that whether such advance is subject matter of income and whether should it be taxed or not. And therefore, this is a specific paragraph added in the tax audit for one to report in relation to the forfeiture. Now, the question here for tax audit reporting arises is that undoubtedly you have forfeited the advance. Now, the question is that you may have given or the entity may have given the notice for forfeiture, which may have been accepted by the person who has paid the advance, or there may not be an evidence of a forfeiture, or there may not be a settlement under which the advance is forfeited, because there are obligations which the buyer is supposed to follow. You have given them the notice, and then after the notice you have a curation period, and if the buyer does not cure the defect, the recipient of money can issue a notice for forfeiture. But it is not necessary that only because the entity has given the notice for forfeiture, it necessarily will mean that section 56(2)(9) gets attracted. Because it may be subject matter of dispute, because the customer who has paid the advance may refute the notice of forfeiture. And therefore, the question is that if the entity has given the notice, has decided not to credit the forfeiture in the profit and loss account because it believes that it can be still a subject matter of further litigation. And the question is that whether in this scenario, whether 56(2)(9), when will the tax auditor report? Will you report only those forfeiture which is credited to the profit and loss account? Will you report it at a point of time when the advance notice for forfeiture was given? Or will you report when the opposite party accepts the forfeiture? Or will you report when a reasonable period of time after issuance of the notice, where the time limit for taking the matter to the on the courts of law have expired? This is certainly a challenge and a confusion for all of us as professionals, because it does not, the section currently does not give what is time when 56(2)(9) will trigger off. And well, ideally, if it is credited to profit loss account, then I would certainly believe that para 29A will kick in. If it is not credited to profit loss account and notices have been given, this will be a qualitative aspect to decide that whether the forfeiture can be will be reported under paragraph 56(2)(9) or not. As we know, RERA also has specific provisions. The agreements have specific provisions before the forfeiture can be done, and all those aspects will have to be covered up before 29A paragraph kicks in. in terms of, therefore, the next question which comes up in case 5 as I would call it, and this is the immediately next paragraph, which is 29B, and here the question is that whether any amount is to be included as income chargeable under the head income from other sources as referred to in clause 10 of subsection 2 of section 56, which is 56 to 10. Again, for the benefit of the audience, I will read out 5610 is extremely large, so I will not be able to read out everything, but I specifically may want to bring notice to subclause C, in which is any property other than immovable property, and which is subpara B, which says for a consideration which is less than the aggregate fair market value of the property by an amount exceeding 50,000 rupees, the aggregate fair market value of such property as exceeds such consideration. Now, what is the challenge and confusion which is being built around this paragraph? And more so also why I felt that I will bring this paragraph because and will also applies when the promoters of an entity give shares to an ESOP trust where the underlying beneficiaries may be employees of the entity. So here is a case where the entity is not giving its own shares, but it is the promoters of the entity which is handing over the shares to the ESOP trust. For Ind AS 102 requires such share-based payments also to be accounted, even though the shares have been handed over by the promoters. And the question now which flows around is that whether, because the trust has received this without any consideration, it has received by of a gift, the question is that whether the such shares, whether, and this can also be again a part of an extension of the entity, and the question is that whether the ESOP trust is liable under 56 to 10 through the extension of entity in the hands. When you consider it, when you account for such trust in the standalone financial statements, the question would be, will 56 to 10 get attracted? There are various arguments that whether the promoters, when they are giving such shares, whether is it for a consideration or is it without consideration. The fact of the matter is that the promoters are also the residual shareholders when they hand over part of their shares to the trust, and which in turn will go to the employees of the entity. Any accretion in the value of the shares is also a benefit which the promoters are receiving. And therefore, there is a good argument that under 29B, one will not report because the view will be that the shares are not without consideration. But yes, the authorities will have its own viewpoint, and therefore I would urge that the fellow professionals must examine whether the paragraph 29B should be carefully viewed, and there should be sufficient legal position before one says that I will not report anything under paragraph 29B. So what is now the next set of challenge or a confusion? And this is in respect of para 36A, and in this case I am referring to an entity which is the unlisted entity, and therefore to which the section 222 will apply. And the paragraph expects us to report whether the SSE has received any amount in nature of dividend as referred to in subsection E of clause 22 of section 2. And this again has a very large implication also for NBFCs, uh, as we know that 222E requires that the entity must have accumulated profits, and accumulated profits are not defined, and one may take up a view whether the accumulated profits are equal to profits which are capable of being distributed by way of dividend, and so therefore anything which is capable of being distributed as dividend will fall as a part of an accumulated profit, while the controversy under the Companies Act of what is capable of being distributed by way of dividend still continues to remain. But let us have that as one focus to say that accumulated profits represents what is capable of being distributed as dividend. So now take an example here that the NBFC has come into a transition. There is an increase in other equity, and one of the reasons why there will be an increase in equity will be because of the point that under the erstwhile prudential norms prescribed by Reserve Bank of India, the income from NPAs was getting accounted only when realized. And that was also the section 43, which was specifically brought in for the purposes of taxing the income received by the NBFCs or the public financial D, and I'm referring to section 43D. Under Ind AS 109, we have now stage 1, stage 2 and stage 3 classification. You also have under stage 2, which is under a default scenario, but you still have a certain value after all the ECL has been provided for, and the standard requires you to recognize income under the EAR on a credit impaired asset as stage 2, which otherwise under the earlier accounting was only done on the realization basis. Now, as a result of recognition of interest on stage 2 asset, you will have created the credit to your other equity, which means that all of a sudden your value of the other equity increases on account of transition. So now take an example that I had 100 rupees of other equity, which is equivalent to my accumulated profits as of 1st April 2018. The transitional year is 1st April 2017. During 18-19, the entity has given 200 rupees of loan to the covered entity. Since the entity had 100 rupees as accumulated profits, 100 rupees should have been treated as a part of the dividend under 222E. Now, on account of transition and recognition of EIR on stage 2 asset, your other equity now becomes 200. So on 1st April 2017, your other equity increases to 200. And the question now is that whether during 18-19, when you gave 200 rupees of loan, whether the balance 100 rupees as a result of enhancement of other equity will also be deemed to be an income, and whether the tax auditor will be required to report under 36A. Now, technically, this is a matter of debate. The loan has been granted during 18-19. When I granted, I did not have the accumulated profits greater than 100. But when on 31st March 19, when the entity produces its financial statements, on 1st April 18, on account of transitional adjustment, the other equity has enhanced to 200 rupees. This is an extremely debatable and challenging for the tax auditors, whether will this get reported or not? In my view, the authorities will certainly will want to tax, because they will say that the other equity has to be seen with reference to 1st April 18 and not with reference to restated, or rather they will take the restated equity and not the accumulated profits when the loans were granted. And this is going to be a big challenge for unlisted entities with enhanced other equity if it had stage 2 assets. I mean, these are some of the high level questions which I felt I would like to highlight for the benefit of the participants. Over the last 2 years, there have been a lot of questions around Ind AS and the tax audit, but for keeping this webinar little brief, I have not touched upon every aspect. But I thought these were some of the critical aspects for which we should deliberate and come to a view as to how such issues will be dealt through the tax audit. Now that brings us to the question on MAT. And this is one question which I felt I would like to highlight for the benefit of the participants. This is, as we know, Form 29B Part C, which is read with 115 JB 2A, which requires that other than the excluded items, 1/5 of the transition amount should be added or deducted from the book profits for the purposes of arriving at the MAT. And the question which is there for all of us to consider, that the expected credit loss provision which the entity has made on transition date, whether 1/5 of that amount should be, and I'm referring to also the CBDT view in the aspect. And the corollary question is that as and when in the subsequent period, when that ECL gets released or through either a realization or on account of reassessment, whether such write back, whether should be ignored under 115 JB2 explanation 1 small I. And I'm specifically referring to why I said I will want to look at the CBDT view. And I'm referring to question 6, and for the benefit of the audience, I would like to read out the entire question 6, which says that as mentioned in question 1, clause I of explanation 1 of 100 JB2 of the Act provides for adjustments for computation of book profit for the amount or amount set aside as provision for diminution in value of any asset. Convergence date adjustments may include adjustment for provision for bad and doubtful debts, known as expected credit loss adjustment at the time of transition. Whether this adjustment would form part of the transition amount referred to in section 115 JB 2C of the Act. And CBDT, through its circular number 24 of the 2017 dated 25th July 2017, has taken up a view as under: adjustments relating to provision for diminution in value of assets other than one mentioned in question number 1 above shall not be considered for the purpose of computation of the transition amount. Therefore, adjustment relating to provision for doubtful debts shall not be considered for the purpose of computation of the transition amount. Now, 115 JB subsection 2B lists down very specific items which should be considered or ignored while determining the transition amount. While the CBDT has expressed its view that the benefit of ECL as a write-off of 1/5 should not be claimed. But in my view, this view taken by the CBDT is capable of being challenged, and uh, I do believe that the various entities and professional brothers have taken up a view that one cannot read beyond what is specified under the subsection uh, 2A. The question is that if the entity was to take up a view that 1/5 of the transition amount should be taken while computing the MET computation, the question is that whether, as and when it is released, whether should it be added back or not. Here under 115 JB, because of the explanation which has been added, that if the, and I will specifically read out the explanation, which is that I'm reading the proviso to I, provided that where this section is applicable to an SSE in any previous year, the amount withdrawn from reserves created or provisions made in a previous year relevant to the assessment year commencing on or after first day of April 97 shall not be reduced from the book profit unless the book profit of such year has been increased by those reserves or provisions out of which the said amount was withdrawn under the explanation below the second provision to section 115 JA as the case may be. Now, since the transition amount has not been added back in the respective year for the purposes of MET, I would believe that one should not therefore say that the write back should again be reduced. In my opinion, the reversal of the ECL will be the part of the book profit in the respective years. But again, since our topic is the challenges and confusion, I'm sure there can be an alternative view in this aspect as well. The question now specifically in relation to NBFC, as I mentioned in the beginning of my presentation, that the magnitude of such changes for NBFCs may be a little larger compared to some of the other industries who have already gone through the Ind AS implementation. And here I'm specifically referring to para 13D, which says that whether any adjustment is required to be made to the profit or loss for complying with the provisions of income computation and disclosure standards notified under 145(2). And in this case, I am specifically referring to ICDS 4, which is to do with revenue recognition. As we know that for all the NBFCs, the loan origination cost, which is the commission paid to the direct sales agents, there can be third-party call centers. There can be payments to the credit rating agencies for the borrowers. So there are a lot of costs associated before the loans are extended by the NBFCs. Under the Indian GAAP, in absence of any other accounting standard which permitted the entities to do a matching concept, because as we know that under lease standard, under the Indian GAAP, we did have a concept of a direct cost which could have been either treated as an expense of the year or could have been effectively amortized in relation to the lease income. But we did not have a similar standard under the Indian GAAP where the loan or origination cost could have been matched with the underlying revenue of interest income which the entity will earn over the years, and therefore under IGAP such cost had to be debited to profit and loss account. And we also know that under the Income Tax Act, we do not have a concept of a deferred revenue expenditure. And the question here, particularly for NBFCs where the origination cost is a significant portion for them and which is considered while determining the effective rate of interest, the question is that can I or can the entity treat such origination cost as a part of the cost under the profit and loss account, saying that such costs are expense of the year and cannot be amortized to match with the income, and whether my effective rate of interest which has been computed under the accounts after considering the amortized cost, whether that interest under ICDS revenue recognition must be with reference to time value of money rather than under the EIR. This is one area where companies, depending upon the legal interpretation, may be justified in taking up a view that loan origination cost is an expense of the year. However, whether recalculation of the revenue recognition ICD 4 will be done or it will remain outside the reporting under ICD 4 and only the adjustment for the amortization cost will happen through the profit, through the income computation, is a matter of big discussion and deliberation currently. There are ideally the revenue must be restated with ICDS 4 if the company takes up a view that the amortization is expense of the year. This is one of a very large item for NBFCs as well. The second question which comes up particularly also for the NBFCs, and I dealt with the stage 2 income recognition when we spoke about the impact under MAT, and the question again is coming with reference to para 13D, specifically again revenue recognition. And I also invite for the benefit of the audience, I specifically bring out the benefit of section 43D. And as we know that under ICDS, if there are specific sections which deals with revenue recognition, then ICDS will not cover those aspects of the income. And section 43D currently says that income on NPS will be taxed in the year of receipt of money. And now the question, interesting question which is coming up, and not only interesting but also a challenge, is that if the entity has recognized income on stage 2, which also under the RBI prudential norms will be equivalent to non-performing asset only in relation to the realizable value of the underlying asset, you can have one income which is accrued in the transitional on the first day of the transition, and it will be income accrued in the subsequent years as well. And the question is that the income which has been credited on transition to other equity, whether such credit is required to be reported under para 13D or under para 16D, which is any other income not credited to profit and loss account, or not to be reported at all. Now, because there is section 43D, in my opinion, ICD 4 should not trigger. The question is that whether will para 16D get triggered, because the credit is not to the other equity for the assessment year under question, but is on account of transition. in my opinion, even para 16D should not be triggered. And the question which is going to come up for us as tax auditors is that how will we go on keeping track of the underlying realization where the income will have to be offered under section 43D, because the asset is already recognized, the income is already credited to the equity. On realization of that asset, there will be no again credit to the profit and loss account. And so therefore a specific monitoring mechanism will have to be factored as and when the income on stage 2 is actually realized and which is required to be offered under section 43D. Uh, I see this as a big time challenge, and this challenge is also what we saw earlier in relation to 43CA, because if the stamp duty differential has to be added over the revenue recognition period, then again control sheet has to be maintained for such kind of income to be added in the respective years. There are obviously many other small challenges which are around that, but as I mentioned, I wanted to keep this webinar focused on key and significant items. I'll be happy to take questions. I see some of the questions which have been posted by the members. I'm just waiting for my convener to come in. There are obviously lot of challenges which have arisen through the computational which is flowing outside the tax audit, and I can imagine that all of us as practicing professionals are seeing a lot of challenges in terms of for I would say where else till she comes, just trying to see if I can also outside this presentation whether would I be able to provide for any further information. Well, there have been some amount of challenges which we have heard, and this is in relation to FETPL for equity-oriented mutual fund, and the question which was being deliberated through Ind AS on the fair value through profit loss account gain in relation to such mutual fund, whether are they in nature of an equity instrument, and therefore is FEOCI a possibility or not a possibility. Well, the IFRS committee is clear that until the amendment to the definition is done, the mutual fund which are in nature of the even though they are equity oriented, the pass-through benefit will not be seen. I have heard that the taxpayers are wanting to challenge that whether a differential treatment for equity instruments where the taxpayer can choose instrument by instrument under FEOCI, whether a similar treatment should also be given under for the mutual fund, which is today whose gain is recognized under FETPL. But currently, that's a challenge which will remain. Only time will say that whether the on account of a similar treatment for a similar kind of the characteristics, whether the uh, judiciary will agree with the argument of the taxpayer on a concept that while it is FET for accounts, but it should be FEOCI treatment for the tax purposes. I thought this is one point I would have liked to highlight it. One second. Can I have some of the questions?
Yes.
So I have dealt with one question on the point that whether the this is one of the questions which is coming under. I'm not sure the participant has not asked under which paragraph. Let me see if what is the paragraph they're asking this question on.
So, if you want any clarification on the question, you can ask me and again retype this question. Any clarification, I can read out.
So this one question which was asked is that if the property is received as gift, is reporting required in tax audit report under clause 16 as market value is higher than consideration, which is 0. In the clause 16, which is on, but I would presume that this question, assuming that this was received by Ind AS by an entity which is following Ind AS, and the question which will flow is that whether this will go under 56, which is under 20. I would presume that this is not a question under clause 16, but this is this would be flowing through your I would presume this will go under paragraph 29B, which is to do with your 56 to 10 and not under clause 16, which you have asked for. So this will get reported under 29B, clause 29B. I'm not, I don't see the other questions which I can answer because this is not flowing out of any of the tax audit challenges. No, I don't think I can, there are any of these questions which are.
So there's one more can tax audit report for past year for which the filing date is over the revised.
Yes, the tax audit. No, but then, so you want, so the question here is, again, though not flowing out of this topic, and the question is that if one SSE cannot revise the return and assuming that the tax assessments are going on and whether a revised tax audit report needs to be provided. Uh, Practically, we have seen that the tax audit reports during the course of the assessments have been revised and submitted. I think that's about it. Thank you so much. I hope that been able to do justice to the various issues arising out of Ind AS implementation, particularly with reference to the tax audit reporting. Thank you.
Thank you so much, sir, for the session today. I'm sure the session would have helped many of us facing the challenges in tax audit with this Ind AS implementation. I appreciate your efforts, sir, for specifically identifying the issues and trying to address the challenges and the confusions that many of us would be facing with this Ind AS. I think this will surely ease out the difficulties that you may face for the coming tax audit assignments. And with this, we would like to end this session. Thank you all for joining.